Hello trading friends and welcome back to Forex Focus, brought to you by tastyfx. Digging into the July Fed meeting and where the Fed could be sending markets in the future. Another no change from the Fed at their FOMC meeting, but market definitely moving in a certain direction here off of what has definitely been translated as a dovish tone from Powell following the no action from this month's meeting. We'll look at not only the reaction in the stock market, gold market, forex market, but also give you a peek into what Fed fund futures traders are thinking the Fed will do by the end of the year. Ton of data to pour through. Let's start with the price action in the S&P 500. A rough go of it throughout most of July here for the S&P, makes all-time highs above 5,600 and then crashes back down to 5,400, looking like a longer-term reversal there was coming, as it's been a good 2024 so far for the stock market, but S&P's up around 100 handles here today, bouncing back above 5,500, and now just, at the pace that they've been on this year, a couple of weeks away from hitting another all-time high. Obviously not there quite yet, and a decent amount of volatility injected into this market in the last couple of weeks. VIX still, even with the move that we've seen here after the Fed and the bounce back, VIX is still above 14, 15, depending on where you're looking, and so higher than the 11, 12, 13 prints we've been seeing for the majority of this year. And so maybe more downside to be seen, but for the time being, bouncing back with the idea that the Fed could be cutting rates as soon as September, even though they left rates unchanged once again in July. The gold market, though it's been kind of correlated to stocks in the last month or so, you see that same, high print and then coming off of those highs for the second half of July and then bounce back in recent trade. Gold is trading way closer to those all-time highs and very, very close to 2,500 when looking at the gold futures here, with the anticipation that interest rates are going to come lower once again, not only fueling equities, but fueling the non-interest bearing metals market here as well. It's pretty crazy to look at those two charts back to back. The stock market and the gold market, historically not very correlated, but definitely have both been fueled by the idea of lower interest rates, even though we haven't gotten them. Seeing a lot of upside in both of those asset classes off of that idea. So let's look at interest rates and see what has shifted around since Powell spoke after the July meeting. Expectations have been around 75 basis points lower from here to the end of 2024 for the last week or so, but this position has definitely strengthened since this July meeting. I believe it was closer to 55% chance of rates being 75 basis points or lower by the end of the year here going into this meeting. More of the distribution has moved into that camp of, you see there, centered around 4.5%. Right now we're at 5.25%. So like I say, 75 basis points lower from the current rate by the end of the year, by the last meeting in December. A little bit of an outside chance in the column of 100 basis points lower, and that column of only 50 basis points lower is starting to shrink a little bit, but still 33% chance there, and no chance that Fed funds futures markets are thinking that rates won't be changed at all in the remainder of the year, though through the first half, obviously, the Fed has not changed rates yet. They've got some work to do in the eyes of the futures market, And this is also seeped into the US dollar market as well, but not in the same direction as the S&P and gold. US dollar prices falling pretty much across the board, but really we're seeing some major declines with the Swiss francs and the Japanese yen that we'll get to in just a second. But you can see dollar edging lower over the course of the last several weeks as they've been pricing in more certainty around those interest rate cuts from the Fed. And just keep in mind, once again, as an aside, in forex markets, a lot of the supply and demand dynamics are dictated by interest rates and what the central bank is doing. US dollar saw a ton of upside as interest rates were hiked up to 5.25% to 5.5%, where they currently reside, and now on the premise of moving lower, especially against a Swiss franc or a Japanese yen. Let's move to that piece because you'll see an even crazier story the last handful of years. As interest rates moved higher in the US and they didn't move higher in Japan, you saw some strength in this US dollar, and then you see those red bars stacking up as the market is anticipating or getting, I would say, more confidence around the anticipation of lower interest rates in the US. The dollar is starting to come off a little bit in anticipation of that. Why does that happen? What demand dynamics are there in the forex market relative to interest rates? Well, if the U.S. is at 5.25% interest rate and Japan is at 0, essentially where they've been for the last decade, then I can buy U.S. dollars and finance that with a short Japanese yen position and get 5.25% and finance that at 0%. Now, if that's coming in and they're only going to be at 4.5% by the end of this year, then people might not be as driven to own that U.S. dollar. And actually, just as a quick aside, Japan is hiking rates here as most other central banks are looking to cut. But you can explore that on your own. I do want to take a look here at what is driving these potential for cuts in the U.S. and what you might want to look at before the September meeting and before the meeting scheduled for the remainder of the year, because these markets are so efficient. The move will likely happen before the Fed actually cuts or doesn't cut interest rates. Employment has been a huge one here. The story has been for the last 3 years, inflation and high inflation is a problem. And we've been monitoring inflation more than any economic data for the last several years, as it ascended to 8 and 9%, depending on what metrics you were looking at, and now has come off all the way to under 3%. Well, the central bank likes inflation around 2%. That tells you that the economy's moving forward. Prices aren't moving lower. Deflation, not usually a good sign of an economy, but they're not so high as to cause a problem to consumers as they have been at certain points in recent years. Like I say, getting up to 7, 8, 9%, too high. So now that we're under 3% and the Fed is feeling more comfortable with the inflation story, they're still talking about how they want it down to 2%, but at 2.4, 2.5%, they're really starting to split hairs there. But what we're seeing is an employment problem that is rising. In May and June, unemployment ticked higher than what was expected, and the most recent reading was at 4.1%, which is getting a little bit higher than where central banks want that number. If you forgot your macroeconomic class from university, central banks really take a look at inflation and employment statistics. Of course, they look at the economy at large, but they have really set some hard standards around 2% inflation and 4% employment. Anything that's lower or higher than those numbers, and they want to act. And so now as inflation is getting close to 2%, and employment is ticking higher than that 4% number, the central bank is potentially going from, a contractionary period to try to bring inflation lower, high interest rates, to an expansionary period of trying to promote more employment and keep the economy running at a healthy GDP growth rate and everything else, which those numbers have been relatively solid in the U.S. With lower interest rates. And so the question now is, will this unemployment problem get even worse and cause the Fed to not only have to cut 75 basis points, but maybe even more? Maybe they have to cut faster. Maybe some shock to the economy occurs and they have to surprise cut. And also, what will 2025 look like? I know that we're just getting out of July here, but of course, futures traders and options traders looking at what interest rates will be then, and of course, the stock market and the gold market and forex, everybody is looking at all of these prices constantly. So the real source of truth will be the employment data that comes out, non-farm and unemployment data, as well as the inflationary data, though that is quickly becoming less of a big mover. So plenty to watch for as we get into what could be the first rate cut for the U.S. in years in September. Didn't get it in July. That was largely expected, though greater confidence building around that rate cut, and we're seeing that play out in higher stock prices, higher gold prices, and a falling U.S. dollar.